Okay, let's dive right into this explainer. We're breaking down the latest updates from Tax Brief Issue 15 today, and we've got 3 absolutely critical 2026 tax changes that are going to directly impact how you or your clients file. There is a lot of incredibly valuable information to unpack, so let's get right to it.
So what exactly do your W-2, an inherited IRA, and estate taxes all have in common? Well, they're all facing some major IRS rule shifts this coming year. And honestly, whether you're a seasoned CPA managing complex client files or just an everyday taxpayer trying to stay ahead of the game, understanding these changes is literally vital for your wallet and your future planning.
Section 1. New 2026 Form W-2 reporting changes.
Okay, so under the old rule, the W-2 reporting threshold was $600, but for wages paid after 2025, that jumps up to a $2,000 threshold. For the tax pros listening, this means the reporting threshold for wages without federal, Social Security, or Medicare withholdings is getting a significant bump. And, in plain English for the rest of us, it basically just means fewer W-2 forms to worry about when it comes to those smaller unwithheld payouts.
Plus, the IRS is adding a brand new Box 14B specifically for Treasury Tipped Occupation Codes. We're also seeing new Box 12 codes rolling out. You've got TA for Trump accounts, TP for cash tips, and TT for qualified overtime. Now, these are strictly informational tracking updates from the IRS, sure, but they are absolutely going to require a massive shift in how employers prepare their payroll forms next year. It's a real game changer for payroll processing.
Moving on to Section 2, Tax-Free Division of Inherited Estates IRAs.
So, the IRS recently clarified a major headache. They stated that if you do a direct trustee-to-trustee transfer to subdivide an estate-inherited IRA into separate IRAs for individual beneficiaries, it actually doesn't trigger a taxable distribution. Guys, this is a huge relief. It means that once the account is properly subdivided and retitled, any subsequent distributions are reported as income flowing straight to those individual beneficiaries. You completely avoid trapping those messy tax liabilities inside the estate itself.
Which brings us to Section 3, Late Estate Portability Election Relief.
First off, let's quickly define DSUE. That stands for the Deceased Spousal Unused Exclusion. For the everyday taxpayer, this essentially just means a widow or widower can actually use their late spouse's unused estate tax exemption. It's an amazing benefit. But here's the catch. To claim this portability election, you normally have to file a Form 706 on a very, very strict deadline. And missing that deadline, well, that can be an incredibly costly mistake.
But there is a lifeline here. In 2 recent written determinations, the IRS actually granted 120-day extensions for late portability elections. Why? Well, they allowed this because these specific estates had a gross value that fell below the standard filing threshold, what tax pros know as Section 6108A. Because they were under that threshold, their deadline was considered regulatory rather than a strict statutory law set in stone. Basically, it shows that if an estate falls below that mark, the IRS has the administrative flexibility to offer relief if you happen to miss that initial window.
All of this brings us to the ultimate question. Are your 2026 tax strategies truly ready for these changes? Look, proactive planning is absolutely the only way to maximize these updates. Whether that means overhauling your payroll systems for those new W-2 codes, or carefully handling an inherited IRA transfer so you don't trigger a massive unnecessary tax bill. So I'll leave you with this. How will you or your tax professional adjust your strategy before the year ends to ensure you aren't leaving your hard-earned money on the table?